Okay, so you've got this stack of stuff on the Zurich Axioms.
Right.
Maybe it's for a big meeting. Maybe you're just like curious how these Swiss bankers built their fortunes.
Mm-hmm.
Either way, we're going to unearth the real gems here.
Absolutely.
These 12 Zurich Axioms.
Yeah.
They're not just for finance gurus.
Right.
They're about how we all think about risk in any part of life.
That's right.
So think of yourself as someone who's ready to build wealth,
Mm-hmm.
ready to take smart risks.
Yeah.
We're going to break down each axiom
Okay.
with a real story to make it stick.
I like that.
It's sort of like a treasure map, but for making smarter decisions,
I love that analogy.
no matter what you're going after.
And speaking of treasure maps, our first stop is Axiom 1.
Okay?
On risk, always play for meaningful stakes.
Okay, so let's picture this.
Right.
Two friends, Sylvia and Mary,
Mm-hmm.
each with a little money to invest.
Okay.
Sylvia plays it safe,
All right.
puts her cash in that typical savings account
Right.
where it earns a tiny bit of interest.
Makes sense.
Safe, predictable.
Yeah.
Boring.
Boring.
Mary's a bit bolder.
Okay.
She dives into the stock market,
Right.
ready for a potential roller coaster ride.
A year goes by and Sylvia's capital is exactly where she left it.
Right.
Maybe a couple extra dollars from that measly interest.
Right.
Feels good, right?
Secure.
Secure.
Yeah.
Well, Mary's portfolio took a bit of a hit,
Oh,
down about 25%.
most people would freak out seeing that 25% drop.
Of course.
But Mary,
Yeah.
not so much.
You're not Mary.
She's actually excited.
He's got this adventurous spirit.
Yeah.
Sees it all as part of the game.
And that's the core of this first axiom.
Exactly.
Earning a salary, that's great, but it won't make you wealthy.
Mm.
Taxes eat at your income.
Yeah.
Inflation makes your savings shrink.
Right.
It's like you're running just to stay in the same place,
Yeah.
playing it too safe with your money like Sylvia.
Right.
It's like putting $100 in a savings account and getting back $109 a year later.
Okay.
Technically a gain.
Right. But,
Not very thrilling.
yeah, not exactly going to get your pulse racing.
Not at all.
I remember once I put some money in a guaranteed return investment.
Oh, yeah.
The return was indeed guaranteed,
Uh,
a whopping 1%.
wow.
At that rate, I'd be a centenarian before I saw any real growth.
Think about J. Paul Getty,
Okay.
the oil tycoon.
Yeah.
A lot of folks think he inherited all that wealth.
Right.
That's not true at all.
Mm-hmm.
He started as a speculator,
Yeah.
just like anyone trying to make their way.
Right.
But he understood this axiom perfectly.
Okay.
He could have bought tiny shares in oil ventures for peanuts back in the day,
Yeah.
but he knew that wouldn't get him where he wanted to be.
Right.
He was patient, built his capital,
Mm-hmm.
and when the perfect opportunity came along, he played big.
Okay.
He went for meaningful stakes,
Mm-hmm.
and that's how he built his empire.
So it's about being strategic and knowing when to go all in.
Exactly.
But we've all heard that saying.
Right.
Only bet what you can afford to lose.
Which seems to contradict this whole idea of playing big.
Right.
What's the deal with that?
That's where minor axiomite comes in.
Okay.
Always play for meaningful stakes.
Okay.
That common saying, it might sound cautious, but it can actually backfire.
How so?
Think about it. If you're always betting tiny, insignificant amounts,
Yeah.
even if you win, your gains will be equally tiny,
Right.
unless you hit the lottery.
Right.
But let's be real, those chances are, well, yeah.
It's like you said earlier. It's
Right.
like buying a lottery ticket, hoping for a life-changing win with a minimal investment.
Exactly.
It could happen,
Yeah,
but the odds are ridiculously slim.
it's very slim.
The Zurich Axioms are pushing us to be a little bolder.
That's right.
Feeling that slight twinge of worry when you invest,
Mm-hmm.
that might actually be a good sign.
It could be.
It means you're playing for something that matters,
Right.
something that could actually move the needle.
It's about finding that sweet spot
Yeah.
where you're taking a calculated risk. Not recklessly gambling,
Yeah.
but also not being so timid that you never make any real progress.
Okay, so we've learned to embrace those meaningful stakes.
Mm-hmm.
But now what about when we're on a winning streak?
Okay.
How do we know when to walk away with our winnings before it all vanishes?
That brings us to our next treasure on the map.
Okay,
Axiom 2.
all right.
On greed. Always take your profit too soon.
Greed. The ultimate saboteur.
It is.
It's that little voice in your head whispering,
Mm-hmm.
just a little more, just a little more.
Yep.
And before you know it, you've held on too long and watched your gains disappear.
That's greed at work.
This axiom is about recognizing that greed can work against your desire to get rich.
Absolutely.
You see this everywhere.
Everywhere.
Rookie poker players,
Mhm.
newbie investors,
Yeah.
Even seasoned pros sometimes.
In the pros.
They get caught in that trap of thinking the winning streak will never end.
Right.
But inevitably.
It does.
It does.
It always does.
It's human nature, I guess.
It is.
We get a taste of success, and we want more, more, more.
More, more, more.
I remember hearing a story about this woman at a casino.
Oh, yeah.
She was on a roll at the roulette table,
Mm-hmm.
winning hand after hand.
She could have walked away with a small fortune, but she got greedy.
Of course.
And of course, she ended up losing it all.
Just like Sherlock Feldman, the casino manager, used to say.
Oh, yeah. What was that?
If they wanted less, they'd go home with more.
He saw it every night.
Yeah.
People winning, getting greedy, and ultimately walking away empty-handed.
Makes you think, right?
It does.
How many times have we all held on to something for just a little too long, hoping for that even bigger payoff, only to watch it all crumble?
It's so common.
But the Zurich Axioms are telling us that walking away a winner, even if it feels too soon,
Yeah.
is always a smart move.
It is.
And that's where minor axiom the second steps in to guide us.
Okay.
If you don't know what your position is worth, don't speculate.
That's a good one.
You see, sometimes that feeling of not knowing when to sell comes from not truly understanding the value of what we're holding.
It's true.
This is so relatable.
Mhm.
It's like being in a fog, unsure of which direction to go,
Yeah.
because you can't see clearly.
Right.
Imagine you're trying to speculate in real estate.
Okay.
Unlike stocks, where you can check the price every second,
All right.
the value of a property is a bit more mysterious.
It is.
It fluctuates,
Mhm.
and it can be hard to pinpoint its exact worth at any given moment.
Exactly.
This axiom is saying,
Mm-hmm.
hey, before you jump into the game, make sure you understand what you're playing with.
Right.
Get a clear sense of your position's value, its potential upside and downside, before you put your money on the line.
Exactly.
So know your worth, or rather your investment's worth.
Know your worth.
Makes sense.
Yeah.
But knowing when to sell, when to get out,
Mm-hmm.
that still feels tricky.
And that's why minor axiom the third is so important.
Okay.
Decide in advance the point at which you will get out of a speculation.
It's like setting a finish line before you even start running,
Exactly.
which can be surprisingly difficult.
It can.
Okay,
Yeah.
I like that.
Yeah.
Like a mountain climber in thick fog.
Right.
You can't see the peak.
Mm-hmm.
You don't know when it's safe to keep climbing or when to stop before it gets dangerous.
Yeah.
The smart move is to set a point where you turn back regardless of whether you've reached the top or not.
I agree.
It's about avoiding that trap of just a little bit more, which can easily turn into a slippery slope.
It can.
Remember that story we discussed about Alice and Harry?
Oh, yeah, Alice and Harry?
They held onto their property convinced they could get a 10x return on their investment.
Right.
The market crashed and they barely broke even.
If they had set a clear exit point, they could have walked away with a healthy profit,
Yeah.
even if it wasn't that fantastical 10x they were dreaming of.
But it's hard, isn't it?
It is.
Letting go of those what ifs
Yeah.
and being content with a good win,
Right.
even if it feels too soon.
It is.
And of course, not every speculation is going to be a winner.
Of course.
There will be losses.
There will be.
And that's where minor axiom the fifth comes in.
Okay, what's that one?
Don't waste your time regretting past losses.
Oh, that's a good one.
Everyone have that story, right?
Everyone.
The stock you sold that later skyrocketed.
Yeah.
The property you let go of that doubled in value.
It makes me cringe.
Just thinking about it makes me cringe.
Mhm.
But dwelling on it won't change the past.
It won't.
The Zurich Axioms are all about looking ahead,
Exactly.
not getting stuck in the shoulda, woulda, coulda trap.
Right.
Remember that South American speculator who kept buying back into a failing stock,
Oh, yeah.
desperately trying to recoup his losses?
Oh, that's painful.
He ended up losing a fortune because he couldn't let go of the past.
It's a harsh reminder that clinging to past regrets is a recipe for disaster,
Yeah.
especially when it comes to finances.
We've got to learn from our mistakes, sure,
Yes.
but then move on to focus on new opportunities. Speaking of moving on, that brings us to a crucial principle for navigating the sometimes choppy waters of speculation.
Right, bring it out.
Axiom 3.
Okay.
On hope. When the ship starts to sink, don't pray, jump.
Now we're talking.
Okay, this one is about damage control.
Right.
You've all had that investment that goes belly up,
Yeah.
that stock that takes a nosedive.
Right.
But what separates the winners from the losers is knowing when to cut your losses and move on.
It's about accepting that sometimes the best move is to abandon ship,
Yeah.
even if it means accepting a loss.
It's tough.
It is.
But it's often smarter than clinging to the wreckage, hoping for a miracle.
I remember reading about Martin Schwartz, the commodity trader,
Yeah.
and he said something like, I learned how to lose.
It's a powerful statement because it acknowledges that losses are inevitable,
Right.
and knowing how to handle them is a crucial part of success.
I agree.
Think about it like a game of poker.
Okay.
Knowing when to fold, even when you've already put money in the pot, is what separates the amateurs from the pros. What's that?
How?
Amateurs chase pros, assess.
Remember the story of Susan Garner and that office building speculation?
Oh, yeah.
The highway project got delayed.
Right.
The value of the property tanked,
Oh, yeah.
and she kept waiting, hoping things would improve.
Sometimes accepting a smaller loss is the best way to prevent a catastrophic one.
Absolutely.
Which brings us to a great reframing of how we view losses.
Okay, I like this.
Minor axiom the eighth.
All right.
Accept small losses cheerfully as a fact of life.
It's like thinking of those losses as the cost of doing business,
Yeah.
like taxes.
Unpleasant, but part of the game.
It's about embracing this mindset.
Right.
Those small losses aren't failures.
They're learning experiences.
They are.
A necessary part of the journey.
Exactly.
It's definitely a shift in perspective.
It is.
Seeing those losses as opportunities to learn and improve rather than personal defeats.
So we've covered playing big,
Mm-hmm.
knowing when to cash out,
Right.
and accepting those inevitable losses.
Yeah.
But how do we deal with all those predictions and forecasts that are constantly thrown at us?
That's a great question.
Yeah.
And it brings us to our next axiom, which is all about navigating the tricky world of predictions.
Okay.
Axiom 4.
Yeah.
On forecasts, human behavior cannot be predicted.
Right.
Distrust anyone who claims to know the future, however dimly.
This axiom reminds us that the financial world, it's ultimately driven by human behavior, and
Right.
humans are inherently unpredictable.
That's true.
No matter how convincing the arguments or how fancy the charts,
Right.
no one can truly predict the future,
Yeah.
especially when it comes to markets.
It's almost funny the amount of bad predictions that are out there.
Oh, it's unbelievable.
I remember reading about this economist right before the 1929 crash,
Yeah.
confidently proclaiming that stock prices would remain high.
Oops.
Oops.
And it happens in every cycle.
Really?
The Wall Street Journal in 1929 predicted a bright and sunny outlook for the market
Oh, no.
just before everything came crashing down.
Let's talk about a miscalculation.
Then you had Joseph Granville in 1981
Bro.
predicting a huge market collapse. What happened? A massive bull market, the exact opposite.
But it shows you that even experts, with all their data and algorithms, can't escape the fact that human behavior is, or a wild card.
It's a wild card.
It's driven by emotion, by fear, by greed, by a million different factors that are constantly shifting.
Exactly.
Even those self-fulfilling prophecies where a
Right.
prediction actually influences behavior to make the prediction come true.
Mm-hmm.
Even those can backfire.
They can.
Remember Granville's prediction in 1981?
Oh, yeah.
So many people panicked and sold off their stocks,
Right.
creating a temporary dip in the market.
But guess what?
What?
That dip created a fantastic buying opportunity for others,
Oh.
ultimately fueling the very bull market Granville had predicted against.
Irony at its finest.
So basically, we can't rely on these predictions no
Right.
matter how confident the source might seem.
What does this mean for someone who's trying to navigate these markets?
Yeah.
Make smart decisions
Right.
and
Yeah.
avoid getting swept up in the hype.
The key takeaway is to be skeptical.
Okay.
Don't base your financial moves on the whims of so-called experts who claim to know what the future holds.
Develop your own understanding.
Exactly.
Learn to read the signals and trust your own judgment.
So it's back to that self-reliance, that
Yeah.
critical thinking that we talked about earlier.
Don't let the noise drown out your own assessment of the situation.
And as we delve deeper into these axioms,
Okay.
we encounter a principle that challenges our innate human desire to find order in a chaotic world. Axiom 5.
Okay.
On patterns, chaos is not dangerous until it begins to look orderly.
This one is a head scratcher.
It is.
We love patterns, don't we?
We do.
We seek them out. We
Right.
try to make sense of the world by finding those connections,
Right.
those predictable sequences.
It's like that old joke about the guy who stands on a street corner waving his arms to keep the giraffes away.
No giraffes in sight,
Right.
but he feels safer believing he's in control.
He does.
Our minds crave that illusion of order,
Yes.
even when it doesn't exist.
And in the world of finance, this can be a dangerous trap.
Remember Professor Irving Fisher,
Oh, yeah.
the economist who thought he had cracked the code of the stock market?
The code.
He created all these formulas, saw patterns in the chaos, and predicted a permanently high plateau for stock prices
Oh.
right before the 1929 crash, of course.
Of course.
He's a brilliant man.
Yeah.
But he fell victim to the same illusion of order
Yeah.
that snares so many investors.
So many.
We want to believe that we can tame this wild beast of a market,
We do.
that we can impose our will on its unpredictable movements.
Right.
It's like those Citibank bankers who convinced Mark Malabra to invest in stocks that later plummeted.
Oh, no.
They had their charts, their analysis, their proven strategies.
Yeah.
All creating this illusion of control,
Ah.
this sense that they knew what they were doing.
But the market had other plans.
So the takeaway here is to be wary of those who claim to see order where there is only chaos.
Be wary.
The more confident they seem in their predictions, the more skeptical you should be. Question everything.
Yes.
Dig deeper.
Mm-hmm.
And don't be afraid to challenge those neatly packaged narratives.
Speaking of questioning narratives, there's this whole idea of looking to the past for guidance.
Right?
Which seems pretty logical on the surface.
Yeah.
But I guess the Zurich Axioms have something to say about that, too.
You bet.
Minor Axiom V warns us about the historian's trap.
Okay.
It's that tempting belief that history repeats itself in a predictable way,
Yeah.
that we can learn from the past
Mm-hmm.
and apply those lessons to the future with certainty.
I get that.
Yeah.
We see those historical trends.
Right?
We think, okay, this pattern played out before, so it's bound to happen again.
Mm-hmm.
But is it really that simple?
The market is a dynamic creature,
Right.
constantly evolving, influenced by a million different factors.
Okay.
Those past patterns, they can break down without warning.
So history can be a useful guide,
It can.
but we can't rely on it blindly.
No.
We need to be aware of those shifting variables,
Yeah.
those unexpected events that can disrupt those seemingly predictable patterns.
And just as we need to be skeptical of the historian's trap,
Right.
we also need to be wary of the chartist's illusion, as Minor Axiom the Sixth caution.
Charts.
Yes.
They look so convincing, don't they?
They do.
Those lines, those graphs,
Right.
they create this illusion that we can somehow visualize the future,
Mm-hmm.
identify those magic patterns that will lead us to riches.
But as enticing as they might seem,
Yeah.
those charts can be incredibly misleading. They can make random data look like meaningful patterns,
Okay.
creating this sense of order where there is only noise.
And often this illusion is exploited by those who want to sell us on their foolproof systems for predicting market movements.
All the time.
I've seen those Wall Street guys hunched over their charts convinced they've cracked the code.
But the market doesn't follow their neat little lines, does it?
It does not.
It's constantly moving, changing, driven by forces that are often unpredictable and irrational.
So it's back to being a critical thinker, right?
It is.
Don't let those charts seduce you with their illusion of order.
That's right.
Look beyond the pretty pictures, dig deeper, and understand the underlying data.
Speaking of digging deeper, Minor Axiom the Seventh warns us about another dangerous mental track.
Okay.
The correlation and causality delusions.
The classic mistake of assuming that because two things happen together,
Yeah.
one must have caused the other.
Right.
But the market, as we've learned, is often driven by random events,
Yes.
by coincidence, rather than some grand causal scheme.
Remember that story you shared about IBM and Honeywell stock?
Oh, yeah.
You noticed they often moved in opposite directions and assumed there was some hidden causal link.
I thought I had discovered this brilliant insight. Big investors shifting their money back and forth, creating this predictable pattern.
But it turned out to be pure coincidence.
They did.
Those price movements were likely driven by completely unrelated factors, and you learned that the hard way when both stocks suddenly tanked together.
It's a good reminder that our minds are naturally inclined to seek patterns,
They are.
to find explanations, even when those explanations are based on faulty logic.
Right.
We crave order, but the market often operates in a realm beyond our neat little causal frameworks.
Exactly.
So be careful about jumping to conclusions, especially when it comes to those seemingly obvious cause and effect relationships.
Question your assumptions, look for evidence,
Right.
and be aware that sometimes things just happen randomly,
Right.
without any grand scheme or hidden logic.
Now, moving from the intellectual traps to the emotional ones, we come to a principle that challenges our attachments to our investments.
Okay.
Minor Axiom IX. Do not become trapped in a souring venture because of sentiments like loyalty and nostalgia.
This one's all about letting go, isn't it?
Yeah.
Recognizing when it's time to walk away from an investment, even if we have emotional ties to it.
It's easy to get attached to certain investments,
It is.
to feel like we're betraying a company or a property by selling it,
Right.
even when it's clearly not in our best financial interest.
We've all heard stories about people who held on to properties for too long because of sentimental value,
Right.
even as the neighborhood declined and the value plummeted.
Or those who remained loyal to their company's stock,
Yeah.
even when it was clearly heading toward bankruptcy.
Like Janice Shattuck, the realtor,
Yeah.
whose friends refused to sell their house because they had roofs in the neighborhood.
They were emotionally attached to the place.
They were.
They ended up losing a lot of money because their sentimentality clouded their financial judgment.
And remember that engineer who held onto stock in his failing company out of loyalty? He knew it was a sinking ship, but he couldn't bring himself to abandon it.
Emotions are powerful forces,
They are.
but they can also lead to costly mistakes in the world of finance.
So how do we detach ourselves from those emotional attachments?
That's the question.
How do we make clear-headed decisions when our heartstrings are tugging us in a different direction?
Minor Axiom X offers some guidance.
Okay.
Never hesitate to abandon a venture if something more attractive comes into view.
It's about staying agile,
Yeah.
being willing to pivot when a better opportunity presents itself.
Remember that story about your friend, the stamp collector?
Oh, yeah.
He had doubled his money,
Right.
but he couldn't bear to sell his collection.
He loved those stamps.
He was emotionally attached to it,
He was.
even though it was preventing him from pursuing other potentially more lucrative opportunities.
It's like that feeling of being torn
Yeah.
between a safe, comfortable investment and a risky, exciting new venture.
The safe one feels familiar,
Right.
but the new one might offer a much bigger payoff if we're willing to let go of the old.
It's about recognizing that sometimes the most profitable move is to walk away from something we're emotionally attached to.
Yeah.
To stay mobile, to be open to new possibilities, and to seize those opportunities when they arise.
Though detach from those emotional anchors and be ready to sail toward new horizons.
I like that.
Speaking of navigating choppy seas, how do we deal with those situations where an investment just keeps sinking and we're tempted to ride it all the way to the bottom?
That's a tough one, and Minor Axioms and I offer some wisdom for those tricky scenarios.
Okay.
If you are going to ride a loser all the way to the bottom, make sure it is a small one.
This doesn't mean stubbornly holding on to every failing investment, hoping for a miracle turnaround.
No.
It's about acknowledging that sometimes an investment will fail completely,
Right.
and we need to be prepared for that possibility.
The key is to manage risk.
Yeah,
Make sure that any potential loss is an amount you can comfortably absorb
right.
without jeopardizing your overall financial well-being.
Don't bet the farm on a long shot,
Exactly.
especially if you're not prepared to see it through to the bitter end.
It's about knowing your limits,
Yeah.
your risk tolerance, and not letting emotions like stubbornness or pride drive your decisions.
Sometimes accepting a small loss is far better than clinging to the wreckage and risking a catastrophic one.
Now, this leads us to a principle that emphasizes flexibility and adaptability.
Okay.
Axiom 6.
Right.
On mobility, avoid putting down roots. They impede motion.
It's like you said earlier about being willing to jump ship when things start to go south.
Right.
This axiom is all about staying agile mentally and financially.
Yes.
So we're ready to move when the market dictates.
Think about Paula and her experience with Ford stock.
Okay.
She'd built her entire financial plan around that dividend income. And when the company struggled, she refused to sell, clinging to the hope that things would go back to the way they were.
She'd put down roots emotionally and financially,
She had.
and those roots prevented her from adapting when the situation changed.
It's like building a house on a fault line.
Oh.
You might love the location, but you're setting yourself up for disaster.
It's a great analogy.
This axiom is about staying nimble,
Yeah.
being willing to move on when an investment sours, even if it means abandoning a plan we've carefully constructed.
Okay, so detach from those emotional anchors and be ready to set sail when the winds change direction.
I like that.
But there's another trap I've seen people fall into,
Oh, yeah, what's that?
getting fixated on a particular stock,
Uh-huh.
especially one they've lost money on.
Yeah.
Almost like they're trying to get revenge on the market.
Right?
Have you ever seen that happen?
All the time.
Like your friend who was obsessed with Sears stock?
Oh, yeah, I remember him.
No matter how poorly it performed, he just couldn't let it go.
I know.
The Zurich Axioms call this chasing a loser.
Chasing a loser.
You lose money on a stock,
Right.
and instead of moving on, you keep investing more, hoping to make it all back on that same sinking ship.
It's an emotional reaction, isn't it?
It is.
Driven by that stubborn refusal to admit defeat.
But it's a dangerous game to play.
It's crucial to remember that a gain is a gain regardless of where it comes from.
Right.
Don't get fixated on a particular investment just because you have a history with it,
Yeah.
especially if it's a negative one.
It's like staying in a bad relationship
Exactly.
because you've already invested so much time and energy into it.
I know.
Sometimes the healthiest thing to do is to walk away and find something better.
And this brings us to a principle that challenges our deeply ingrained belief in planning,
Okay.
Axiom 12.
All right.
On planning long-range plans, engender the dangerous belief that the future is under control. It is important never to take your own long-range plans or other people's seriously.
Wait, hold on.
What?
Aren't we supposed to plan for the future?
Of course.
Set goals,
Yeah.
create strategies,
Oh, great. Yeah.
map out our financial moves.
Planning is important,
Okay.
but the Zurich Axioms are cautioning us against getting too attached to those plans.
Okay. In a world of constant change, those long-range plans can quickly become obsolete.
Right.
They can create a false sense of security,
Yeah.
a belief that we've somehow tamed the unpredictable forces of the market.
Remember that story about George and Martha, the couple whose retirement plan was completely wrecked by unforeseen circumstances?
Oh, yeah, George and Martha.
They had it all figured out, but life, as it often does, threw them a curveball.
It's a reminder that the future is inherently uncertain.
That's for sure.
We can make plans, but we also need to be prepared to adapt when those plans inevitably get disrupted.
So it's about finding that balance between planning and flexibility.
It is.
Being prepared for the unexpected.
Right.
And not letting those carefully crafted plans blind us to new opportunities or challenges.
Precisely.
And as we move into the final stretch of our deep dive, we'll explore how to cultivate that mental flexibility, that ability to adapt and thrive in a world that's constantly throwing us curveballs.
I'm ready for it.
Bring on the curveballs.
Right.
Let's do it.
So we've covered a lot of ground here.
We have.
From playing big to accepting losses. From being wary of predictions to understanding the illusions of order.
Right.
Now, where do we go from here?
That's the question.
How do we put all these Zurich axioms into practice?
It's about integrating these principles into our thinking. Recognizing that the financial world, like life itself, is full of surprises.
Yeah.
And maybe those surprises aren't something to fear, but something to embrace.
Embrace the unexpected.
Embrace the unexpected.
That sounds a little counterintuitive, especially when we've been talking about managing risk-making calculated decisions.
Think about it this way.
Okay.
We spend so much time trying to control things, to predict outcomes, to stick to our meticulously crafted plans.
Right.
But what happens when those plans get derailed?
When an unexpected event throws everything off course?
Yeah.
Well, it can be pretty frustrating.
It can.
We feel like we've lost control, like all that planning was for nothing.
Exactly, and that's where the Zurich Axioms offer a different perspective. Instead of clinging to the illusion of control, they encourage us to embrace the unpredictable nature of the market, to be flexible, to adapt, and to see those unexpected turns of events as potential opportunities.
Okay, I'm starting to see where you're going with this. So instead of freaking out when things don't go according to plan, we should try to see those disruptions as possibilities.
Precisely.
It's like navigating a ship through uncharted waters.
I like that analogy.
You can have a destination in mind. You can chart a course. But you also need to be prepared to adjust your sails when the winds change.
Yes.
When unexpected currents emerge, when unforeseen obstacles appear on the horizon.
That's a great analogy.
It's about being responsive to those changing conditions.
Right.
Rather than rigidly sticking to a plan that might no longer be relevant.
Remember Axiom 12, the one about not taking long-range plans too seriously? Yeah. It's all connected. The future is inherently uncertain.
Right.
And those who can adapt to those uncertainties, who can embrace the unexpected,
are the ones who are most likely to thrive. So it's not about abandoning planning altogether.
Right.
It's about holding those plans loosely.
Exactly.
Being willing to deviate from the course when a better opportunity presents itself, or when an unexpected obstacle forces us to change direction.
Exactly. And this leads us to a final provocative thought to ponder.
Okay, hit me with it.
What if, instead of fearing the unexpected, we learn to see it as the source of opportunity?
That's a big shift in perspective.
It is.
But I can see how it ties into everything we've been talking about.
Yeah.
Instead of getting bogged down by losses or clinging to outdated plans,
right,
we'd be more open to those unexpected twists and turns that might lead us to something even better.
Imagine approaching the world of speculation.
Mm-hmm.
Not as a game we can master,
Okay.
but as a journey of discovery.
A constant exploration of the unknown.
Exactly.
It's a more adventurous approach, for sure.
It is.
Less about control, more about navigating by the stars, trusting our instincts, and being open to the possibilities that lie beyond our current understanding.
It's about recognizing that in the world of speculation, as in life itself,
Right.
the most rewarding experiences often come from those moments when we step outside our comfort zones,
Okay.
when we embrace the unknown, and when we allow ourselves to be surprised by the unexpected.
So as we wrap up this deep dive into the Zurich Axioms,
Yeah.
the message I'm hearing is this.
What is it?
Be bold, be smart, be adaptable, and don't be afraid to venture off the beaten path.
Those unexpected detours might just lead you to the greatest treasures.
So go out there, take some calculated risks, and don't be afraid to embrace the unexpected.
I love it.
Who knows what you might discover along the way.
Until next time, happy speculating.
Now we get to the fun part.
Okay.
Axiom 7.
All right.
On intuition, a hunch can be trusted if it can be explained.
Intuition.
We all have hunches, right?
We do.
Should we trust them?
Intuition can be a powerful tool,
Yeah.
but it needs to be tempered with reason.
So explain the different approaches to intuition.
Well, there are 3 basic approaches.
Okay.
You can scorn it, you can trust it indiscriminately, or you can use it discriminatingly.
And the Zurich Axioms advocate for...
Discriminating use.
Okay.
A hunch can be trusted if it can be explained logically.
So it's about being able to articulate
Yes.
why you feel a certain way about an investment,
Exactly.
not just blindly following your gut.
And speaking of blindly following your gut,
Yeah.
Minor Axiom in 12th warns us,
Okay.
never confuse a lucky break with a smart move.
Oh, this is a good one.
It is.
Because it's so easy to get caught up in the excitement of a win
Right.
and attribute it to our own brilliance.
When in reality, it might have been pure luck.
Remember Jesse Livermore
Oh, yeah.
and that Union Pacific short?
He made a killing, but it was because of the San Francisco earthquake,
Right.
not his amazing market predictions.
It's a good reminder to stay humble and to acknowledge the role of chance in our successes.
It's easy to mistake luck for skill.
It is.
Be honest with yourself about the role of chance in your successes.
Now let's talk about something a little more controversial.
Oh,
Axiom 8.
all right.
On religion and the occult. It is unlikely that God or other supernatural forces will intervene in your speculative life to make you rich or keep you poor.
This one always sparks debate.
It does.
But let's be pragmatic.
Okay.
There's no evidence that God plays favorites in the stock market.
So whether you're a devout believer or a skeptic,
Mm-hmm.
this axiom is about making clear-headed decisions,
Exactly.
not relying on divine intervention or occult powers for financial success.
It's dangerous to rely on those things because it creates a false sense of security.
Now let's talk about the power of mindset.
Okay.
Axiom 9.
Right.
On optimism and pessimism. Optimism means expecting the best, but confidence means knowing how you will handle the worst. Never make a move if you are merely optimistic.
Optimism is overrated,
Especially in speculation.
especially in speculation.
Professional gamblers understand this.
Mm-hmm.
They focus on minimizing losses, not on blind hope.
Remember Sam and Judy,
Oh, yeah.
the young couple who were too optimistic about their land investment?
Right.
They didn't have an exit strategy and ended up losing their money.
Ask yourself,
Okay.
am I being realistic or just hoping for the best?
And of course, we have to address the role of superstition.
Of course.
Minor Axiom the 13th tells us
Yeah.
a superstition need not be exercised. It can be enjoyed provided it is kept in its place.
So it's okay to have your lucky rabbit's foot or your pre-trade ritual,
Yeah.
but don't let those things dictate your investment decisions.
Remember Charles Kellner?
The guy who won the lottery multiple times
Yeah.
because of a dream.
He uses superstition for fun,
Right.
but it doesn't affect his serious investments.
Keep your superstitions in the realm of play, not serious finance.
Now let's talk about the herd mentality.
Okay.
Axiom 10.
On consensus, disregard the majority opinion. It is probably wrong.
This axiom challenges us to think differently,
Yeah.
to question conventional wisdom.
Because what everyone is doing
Yeah.
is often the wrong thing to do,
It is.
especially in investing.
Remember Chrysler stock in the early 1980s?
Yeah.
Most people avoided it.
Right.
It was considered a terrible investment.
Huh.
It ended up being a huge winner.
The herd is sometimes right, sometimes wrong.
Exactly.
You need to make independent judgments.
Which brings us to a very common emotional trap.
Okay, what's that?
Axiom 11.
All right.
On stubbornness. If you already own a stock, don't buy more of it just because the price has gone down.
We've all been there.
We have.
You buy a stock, the price drops, and you think, oh, I'm getting a bargain.
A bargain.
So you buy more.
Right.
But often that's just throwing good money after bad.
It is.
Remember your experience with IBM stock?
Oh, yeah. That was a tough lesson.
You kept buying more as the price kept falling.
I was convinced it'd turn around.
Stubbornness can lead to chasing losses.
It can.
Which is a dangerous habit.
So the key takeaway here is don't let your emotions cloud your judgment.
And finally, we come to the last axiom.
Okay, bring it home.
Axiom 12.
All right.
On planning long-range plans, engender the dangerous belief that the future is under control. It is important never to take your own long-range plans or other people seriously.
This axiom is a reminder that life is unpredictable.
Yeah.
And the future is never set in stone.
We can make plans, but we also need to be prepared to adapt when those plans inevitably get disrupted.
So there you have it.
The 12 Zurich Axioms.
12 powerful principles for navigating risk and uncertainty.
They're not just about making money.
No.
They're about making smart decisions in all areas of life.
So go out there and embrace the unexpected.
And until next time, happy speculating.